We will pause for just a moment while Zoom loads all the attendees into the webinar. And thank you so much for joining us at our inaugural State of the Industry webinar. This is a members only meeting, so thank you so much for all coming today. We will be releasing the webinar to the public and to members in the recording archive in 2 weeks. So if you're here today, you are getting the most up-to-date recent data. And if you're not, you're watching this on our recording, and hopefully you can join us live next time. Before we begin, I have just a few AAPL announcements, the first of which many of you are aware we have our annual conference coming up for the first year in a row, or for the 14th year in a row, on this November 12th to 13, 2023 in Las Vegas at our very normal Caesars Palace. So we do have our early bird registration open right now. It is the least amount you're going to pay for tickets at any point in time. Head over to aaplconference.com to get your ticket and find out more about the nation's largest private lender event today. Next up, for those of you who are members, which should be all of you on this call, you can become a certified fund manager or certified private lender associate from literally anywhere. We have our online courses now for both of those courses. They're $349 each, and you can find out more information about what's in them at aaplonline.com/courses. And we do have our CPLA commercial asset course coming soon. We are wrapping up details on those videos now, so please stay tuned for those to come up. Next, we do have our AAPL member spotlight. We like to talk about our members everywhere and anywhere that we can. So we just want to remind you that this is another way you can promote yourself across our network. Please sign up for the member spotlight online at aaplonline.com/spotlight form. And then you can go ahead and we'll add you to the queue. So there's no cost to do this. It's completely free. We just ask that you have done it before. And we want to let everybody know who you are and that you're an AAPL member. And finally, some housekeeping for today's webinar. So as I mentioned at the header of this, the State of the Industry webinar recordings will be available 2 weeks after the webinar. So you do want to attend live for the most up-to-date. We're going to hold these very close to the chest until we have that 2-week public announcement following the webinar. And then as far as asking questions during the webinar, you are more than welcome to interact with our panelists here today. We ask that you drop those questions into the Ask a Question feature to be added to that QA. It's a little bit easier for us to manage the very many questions that can come through if they're not in chat. So keep them in the QA. That way we can make sure that we address all of them and or keep them for after the webinar and make sure that we send them to Sean and Nema so that they can answer them if we aren't able to get them to everybody during the webinar. And finally, I have introductions for today's webinar. We are doing our inaugural State of the Industry update. And here's what we know. Rumors continue to fly about large shops shutting down, origination volumes that are all over the place, and there's general uncertainty across the board. Cutting through the hyperbole and the rumors that we're hearing to get to the real data will be Nema, CEO of Lightning Docs, the official loan document provider of AAPL, and Sean, CEO of Forecasa, or a leading aggregator of private lending recording data. Expect real-time and historical rates, true loan volumes by market, and an accurate understanding of today's market shifts. So, and with that, I'll hand things over to Nema to introduce the rest of the webinar and Sean today. Thank you very much.
Appreciate that, Kat, and thank you for the kind introduction as always. Very excited for this series. Had an opportunity to meet with our friends at AAPL towards the tail end of last year, and wanted to make sure that we were participating in a meaningful dialogue on a consistent basis about the state of the industry. So every few weeks, you'll be able to catch on to this. And the goal of this series is to really provide an accurate gauge of what's happening in the industry. And I'm extremely excited about the way we are kicking it off today. And it was intentional about who our panelists is today. And so we'll be rotating panelists throughout the series, but today you're really going to get the best of everything. So as Kat said, my name is Nema Daghbandan. I'm the CEO of Lightning Docs. For those that don't know, it's a software program we created here at Drosy LLP that generates business purpose loan documents. For your purposes and your relevance today, what it also does is it aggregates loan level data of the users within the system. And that's what we're going to be talking about a little bit today to understand what are the current interest rates and volumes and regions and just really specific data points. And then we have Sean here with us today as well. And Sean and I have gotten to know each other the past few months. For full disclosure, we're actually now a user of Forecasa as of last week, because we have found what they do so meaningful. Sean will be able to do a much better job of explaining how he does what he does and what Forecasa does. But for your purposes, know that the data that Forecasa has is unique. It is a product specifically built for the private lending industry, and it tells you in real time what is happening and the data set it has is better than anyone I've ever seen before. So very, very excited to present on that today. And thank you, Sean, for joining me on this today.
Thanks, Nema.
So the first thing we want to do here is we'll get into the data, but I also want to give you a little bit of what I would say is a casual observer standpoint of the industry as a whole. As you all know, or anybody that knows me, is I very much love this industry and I'm very intrigued by it, and it is something that I enjoy being an observer of. The most recent thing to report back is I recently attended a securitization conference with my partner Kevin, and we talked to a good number of institutional capital providers, the Wall Street banks that end up securitizing these loans and trading them in big loan tranches, as well as the aggregators who sell to them, as well as the individual clients that are interested in this world. And here are some of the themes that came out from that meeting, and I think I wanted to convey that to all of you. So the first thing here is, as many of you know, the securitization market, particularly starting around June of last year, really wasn't as consistent and reliable as it was prior to that point. That continues to be the case today. From the way I view it is there's around a 1% or 100 basis point gap between what the securitization market is willing to pay for residential transition loans or bridge loans or fix and flip loans, however you want to describe them, and what the marketplace is willing to price them out, meaning what the borrowers are willing to accept, your borrowers are willing to accept. So in order to bridge that gap, the marketplace today should probably be originating loans closer to the mid 12s rather than where we are sitting today in the low 11s. And we'll get into the specific data points, but the securitization market believes you are pricing loans too low. And that's the gap that currently exists. And maybe they're wrong, maybe you're wrong, we'll find out. But at the end of the day, there is truly a gap, and securitization is generally not an option for liquidity in the way it once was. And that is the next issue, which is there is generally a lack of liquidity. That's no surprise. And what that means is that there are fewer bond buyers interested in these bonds. We saw that and heard that through our conversations when we were out. It became very clear that what was once the kingmaker was the originator with significant deal flow who could fill these buckets. That is no longer the case. The kingmaker is the bond buyer who is interested in buying bonds, and in a rate-starved world, a first position secured loan had a lot more of an attractive position than it does today, in which there are lots of different offerings available. There's lots of different asset-backed securitizations available. It's not just mortgage loans. And so you are fighting against many different asset classes in a different yield environment. The third point is that there is an expectation of non-performance. And what I mean by that is that there is a significant interest in non-performing loans and a belief that there will be a flood of non-performing loans. And that's where the money is going to wait for, is they believe that's where the market opportunity is, rather than in what many of you originate, which are obviously performing residential transition loans in their parlance. And the last point on here is that the portfolios that are being held right now, there's not nearly the level of payoffs there once was, which makes sense. Obviously, interest rates are much higher. For a residential transition loan, the goal would be to sell the asset to a home buyer, and they are trying to buy your property in a very challenging rate environment themselves. And similarly, if the option was for them instead to convert into a rental loan, also similarly challenging rate environment. So what does that mean is those loans, instead of paying off as they once traditionally would and reliably would, instead, those portfolios are now extending in 6-month extensions and 1-year extensions. And typically those extensions are really better described as modifications because there's an adjustment of interest rate typically that's occurring. But that's creating its own form of liquidity is those same parties holding the loans, aggregators and others that are holding these loans, they are not getting the cash payout. So they have their own lack of liquidity. So put this all in a nice little bun is there's just a lack of liquidity in the market. And you will see that in the volumes and you will see that in where we sit today. So, there's the expression, don't fight the Fed. The Fed wanted us to have less liquidity available, and they are doing a very good job of doing that. So that is where the market sits today. So let's talk a little bit about what is the data that we're analyzing and what are we looking at. So I'm going to speak specifically about Lightning Docs, and Sean will obviously talk about Forecasa and the data they aggregate. So in Lightning Docs, just very high level, since its inception and we started, and what it represents is just software that we license out to our clients, permitting them to write up business purpose loans. There are over 30,000 loans since we started offering this as a product offering back in 2018, and almost $18 billion of transactions. We're not going to discuss all 30,000 and all 18 billion because it's irrelevant what was happening in 2018. It is very relevant what happened in 2022, and even more relevant about what's happening in February of 2023, which is the data points I'm going to spend most of my time discussing today. So the first thing we're going to discuss here is let's take a look a little bit about what happened on a quarter by quarter basis in RTL or bridge or fix and flip volume. So by definition, to me, the loans I'm looking at here are loans of a duration of 3 years or less is the loans that I'm looking at. They may have a construction component, they may not. So as long as the duration is one of less than 3 years, the data set that I'm looking at here specifically are users of Lightning Docs who are a user as of January 1, 2022. So if you became a user on February 1, 2022, you would have been excluded from this data set, because what I'm trying to understand when I'm thinking about volumes is I want to track the exact same people and what is happening with those same people over time to give a real understanding of how is the industry doing, or at least the subset of users that use our software are doing during this time period. Well, I don't think this slide will surprise a lot of people, which is that volumes peaked in Q2, and this is specifically looking at bridge loans, and then it started decelerating in Q3, further decelerating in Q4, down 15%, and then down 12%. In terms of total number of users here, you're tracking about 75 users is what this data set represents. So then let's take a little bit more of a granular look. Let's look month by month for the past 6 months. So same kind of thing as long as you were a user as of September 1 of 2022, now I'm tracking you and seeing what's happening. So this data set's about double the number of users. We're now looking about 150 users, and what is happening with those 150 users from September 1 through February of 2023 and the volumes for those users. So a slight uptick in October, but then kind of bad news from that point forward, with more significant decreases in December, January, and now February. So fairly significant volume declines occurring, and it was pretty consistent kind of going into this time period. So we are seeing real declines and more significant declines over the past 6 months. So the next one here is looking at those same data points and same parties. So now we're tracking this by interest rate and by loan amount. One thing to note on here is from a data perspective, I pulled out all loans that were greater than $2 million because I was starting to skew the loan amount data unnecessarily. And then I also pulled out any user that had artificially low interest rates. So for example, if a user has some teaser rate style program and that's unnecessarily dragging down the curve, I pulled them out because I wanted to try to find as pure of a real average as we could get here. So what you're seeing here when you start going through the years, it started off about 9.3%, and it went up to an average of 10.9% when we're looking at Q4 by average. Kind of going back into what I talked about earlier about the securitization market, they're probably right, which is if you had a 300 basis point increase in the market during that time period, you're not seeing it reflected here in the nominal interest rates being offered, right? You're still pretty far off. So, we really do have another 100 basis points to go to be rationally priced. In terms of the loan amount, that's going down, which makes sense. As you know, buy boxes have gone down in leverage in any sort of loan, whether it's DSCR or whether it's RTL. You are seeing a delevering of risk. And so the loan amounts are going down at the exact same time that interest rates are going on. And that's the squeeze that I'm sure many of you feel. Applying the last 2 months from an interest rate environment, I am seeing an average across all users at 11.1% in January and 11.3% nationally in February. And these are the loan amounts. The loan amounts are staying fairly sticky in that low 400-ish range. So when I wanted to segment that apart a little bit, because if you just kind of look, going back one slide, we're over here at 11.3% in February. Well, what does that really mean? What does that translate into? Well, when you look at the underlying data sets here, what you see here is that 80% of loans are being priced between 10 to 12%, with some outliers a little bit lower, some outliers a little bit higher. Within them, 11% is the predominant, or within the 11 to 12% band is probably a better way to understand that, is the predominant at 35%. But there's a significant proportion in the 10 still, and there's a significant proportion a little bit higher in the 12. So that's the band that we're seeing people stay within currently. In terms of where are the best opportunities, at least from a yield environment. So we looked at the data and said, in the year 2022, interest rates, what were the highest interest rates in statistically significant states? Because we have, some people really do make loans in South Dakota, but we don't have enough data there to meaningfully support what is the interest rate climate there. But as long as there were at least 25 loan transactions in any given state, wanted to report back on that. So looking at 2022, it was Michigan, Utah, Arkansas, Wisconsin, and Ohio, which were producing the highest average rate throughout the entire year. Moving into this year, Michigan continuing to lead, Colorado as a new entrant. We're seeing Washington, Ohio, and South Carolina as the states with the highest nominal rate currently. This is just the interest rate. So some people will ask me as well, is this including points? I have no idea about points. This is just looking at the interest rate data right here. And then for purposes of scaling and looking into the data for this year, right, just meaning January through February 28th, I looked at states that had at least 15 loan transactions, because again, anything less than that, I don't think is meaningful to report back on quite yet. So then where are people lending, at least our users? On the bridge side of it, specifically, California remains king and has done so. Texas and Florida are swapped in 2022 and have stayed there. And you're seeing a little bit of movement up and down so far in 2023 as compared to 2022. This doesn't really surprise me. Oftentimes we are fielding phone calls from our clients and kind of they will ask, oftentimes they will ask questions about entering a new market. And so, one of the biggest movers has been New Jersey. As you see up here, New Jersey is up 6 from where it was in 2022. And that's not surprising. We have seen a lot of interest in New Jersey here at the firm, and Washington making a big jump up here as well. So we'll continue to track the volumes. Again, we're too early in the year, so I don't know if I'm you, I don't know if I'm going to start making bets on this quite yet. Sean's probably a better person to talk to about this because his data aggregation is just far more vast than ours, obviously, based on what is being tracked. So switching the analysis, doing the exact same thing, let's take a look a little bit at DSCR. So for me, the way, going into data sets, DSCR to me is a loan of a 360-month duration, right? A 30-year loan is what I'm looking at here at the data set. And same thing too, is when I'm looking at the data set that's being provided right now, is were you a user of Lightning Docs as of January 1, 2022? What is happening with you throughout the year? What was interesting is you're seeing continued increases, right? So big increases in Q1, big increases in Q2, and this space really got hurt at the end of June, right? So you started seeing a big deceleration from Q3 to Q4. Going into the monthly data, so what happened in the past 6 months. So again, just users as of September 1, 2022 through now. And it's all over the place. I mean, what's interesting here is DSCR is a lot less consistent than when I've seen the bridge data. And I don't know if you all are experiencing that as well, but the data is showing me that it's, you know, up some months, down some months, and it's kind of all over the place. When we're looking at the average size of loan and the average interest rate as we trailed through last year, you know, this is also, I think, a much more accurate representation. We talked about our spreads accurate. What happened last year is we had a 300 basis point increase, and we also had a 300 basis point increase here, right? So it makes sense that DSCR loans are much more rationally priced because they're constantly going to market. And so because they are constantly going to market, you are going to get much better price transparency versus bridge loans, which are going to be continue to be held balance sheet and is traded in big portfolios rather than necessarily going to the securitization market unless you have to go to the securitization market. Similar deleveraging of risk, right? Started at an average of $344,000 back in Q1, going down to $276,000 in Q4. So same thing that you're seeing with the bridge. Going into here in terms of the last 2 months worth of data, right? So rates went down just a little bit, which makes sense if any of you were tracking the conventional mortgage market. So did that same trend that was occurring in the conventional mortgage market. They track pretty similar with one another. So as of February, it was 7.8%. I suspect this number is probably going up for anyone who's been watching the conventional mortgage market. That is what's happening there. And so I suspect that you are seeing an increase in interest rates headed in our direction yet again, but at least on average, 7.8% as of last month. What is happening and where are people making DSCR loans? Texas remains supreme. The fight for number 2 continues to move all around, right? So currently New Jersey is the title bearer as for slot number 2. Florida is obviously up there. So interesting enough, it's just different states. But again, for anybody who does both bridge loans and DSCR loans, you know that they are just different. The ability to qualify, particularly from a debt service coverage ratio, you have no cap rates in California. So it makes sense that it's not even showing up on our list anymore in terms of the DSCR product. All right, and I will pass the baton to my dear friend Sean to tell us a little bit about what you're seeing.
Thanks, Nema. Nema didn't give me a heads up he was going to be wearing a suit today, so just full disclosure. No, thank you for teeing us up. Really appreciate the time. You know, Gerasi and AAPL really want to say thanks to having us here. For those that don't know Forecasa, relatively new to the private lending space, but we are long in the data and analytics space. We come from the oil and gas industry, but recently entered into the kind of real estate world. And what we do, Nema mentioned a little bit earlier, but we source, normalize, and visualize county level transaction data. So we're talking about deeds, mortgages, assignments, satisfactions, loan modifications, lease pendants, liens, judgments, all the things that our clients today care about. Most of our clients today are originators, but we also do work with what I would call advisory services like Gerasi and others. We're going to go through and talk about how we normalize the data, right? Because when we go and source the data ourselves, right, we're grabbing all the data. We're not just grabbing private lending data. So what we have to do is we have to normalize that data down to what we actually care about, right? So what does that mean? That means removing the noise. The noise are conventional lenders working with LLCs, commercial lenders, SBA lenders, family trust, self-directed IRAs, individuals that are lending, right? These are all noise that we have to remove in order to have a true analytics platform for private lending, right? So what our team has done is we've built a proprietary method for identifying who these originators are in each of the markets that we cover. Today, we estimate that our data represents about 70% of the US population. And our goal by the end of the year is to get to about 85% of the US population. We go where our clients want to be, right? So we basically got a request this morning to go into Arkansas, right? A client of ours wants to go and evaluate new markets in Arkansas, and they want to know what is the private lending space today there, right? We don't want to go and create a new market. We want to go and try to play in a market that already exists. Okay. So what you're going to see on the screen today is basically the number of private lending mortgages year over year over year. And what's really interesting to see is that we basically ended 2022 where we ended 2020. The difference being we're going in a little bit different direction, right? Because at 2020, we were coming off the low in April with COVID. When we were kind of starting to continue up, you could see the 2021 line was basically, net positive the entire year. And then March of 2022 is really when we declare the peak of the private lending industry. So we'll talk about this in a minute, but we'll see, we try to measure everything from that peak point and where we're at today, because people will ask me all the time, Sean, how bad has the private lending industry been impacted today? And we'll get into that and cover, kind of where we stand from the peak point and where we see things normalizing today. Next slide, please. This is a pretty interesting slide. Nema mentioned this earlier, and it's kind of, uncanny how in lockstep. So what this is looking at is private lending mortgages on the line chart, and then the non-private, so the conventional mortgages on the bar, right? It pretty much moved right in line until January, right? So we just released our January report last week, and that was the first inflection point where we saw that conventional lending has taken a much bigger hit versus the private lending space has started to normalize, right, and stabilize. So we're starting to see that stabilization. We're starting to see capital markets come back a little bit, right? The end of July, I think every single one of our clients were calling us, Sean, who's buying private notes? Whoever I was teamed up with from a capital market standpoint is either tightening their box, closing down altogether, or only, cherry picking the deals that they want to take into their funds, right? So understanding who's buying loans where, that's another thing that we track, because once we identify who are the originators, we can then look to see, well, who are the investors they're working with, and then also who are the capital markets providers that they're also working with, if they're not balance sheeting or using their own fund. So in this slide, basically what you're going to see, the next slide, what you're going to be able to see is the actual change, right? So I mentioned it earlier, right now, as of December, end of the year, we were at 47%. The entire industry's down, right? Versus, the non-private space was actually only down 40%, right? So the private mortgages were actually being impacted more negatively than the conventional space. And again, January and February, we expect that to change. But you can see the change from November to December is the smallest decrease that we've had since this whole thing started, basically, right? Since August. So now we're starting to see it, some things are starting to stabilize, but it's not all markets are created equal, right? So on the next slide, what we're going to show is that there's certain markets, and these are going to be, the kind of top 12 markets we look after. I also have, some others that I'll call out, but Texas, right, has been the strongest market. And something to note in here, these percentage changes are relative percent changes, meaning, yes, Dallas is down from Q3 to Q4, but how does Dallas-Fort Worth stack up against the other markets, right? So this is a relative change. We want to know, yes, anybody could tell us that the whole market's down quarter over quarter, but we want to know, well, which markets are being impacted more than others, right? So you see Phoenix, for example, getting crushed. A lot of the California markets not doing very well, right? But you got Dallas, you got Texas, you got Florida, some others to note that I looked into: Orlando, Jacksonville, Fort Myers, all very strong double-digit percentage gains against their peers. Columbus and Cincinnati, actually, in Ohio, also strong relative to their peers. Some of the laggards, if we're looking at those, are going to be Sacramento, St. Louis, San Francisco, Memphis. I recently, started talking to a client. I said, yeah, we're in Tennessee. He said, well, I want nothing to do with Western Tennessee. I want Knoxville. I want Nashville, Memphis. Don't even, nobody's buying anything in Memphis, unfortunately, right? So knowing your markets are key, right? Because if you don't know on the buy side what people are looking for, you're going to be stuck, holding on some of these loans that otherwise you could have traded previously. All right, next slide. This is a interesting way to look at the market, right? So these are the top 10 lenders. Finance of America would be on this list. They went through a recent reporting change where they moved all their stuff under Finance of America mortgage. But long story short, Finance of America would probably be 5 or 6 on this list right now. But we're currently working on incorporating the back into the data set. But what you can see, right, in any down market, what you would expect is that you would expect the top to grow, right? While the middle market guys shrink because they don't have the capital in order to play in these down markets. But that's not the case here, right? You can see that the top 10 lenders have consistently made up 25 to 26% of the private lending space. Coming from the oil and gas space where we're used to dealing with Halliburton, Schlumberger, Baker Hughes, right? I mean, you're talking about between those 3 service providers, potentially 70 to 80% of the market. Kiavi, the biggest lender in this space, doesn't even have 10% market share, right? And depending on the securitization market, that changes, right? Because they're highly levered to the securitization market, and they can kind of ramp and slow down as needed. But what's amazing is when I looked at this data at the end of the year, only 4 out of the top 10 lenders were actually growing market share, right? If I look at that same statistic today, 2 out of the 4 are actually growing, right? So the way that we kind of characterize it is that in this market, there's a small group of lenders who are thriving. There's a whole bunch of lenders that are surviving. And then unfortunately, there's some that are reorganizing, right? And reorganizing can mean that they're reorganizing under a different company name, which we've seen a couple times recently, or just reorganizing in total and just, making their headcount align with the new norm, right? Which is a much lower level of activity. But what I found is that every lender is now much smarter about the product offering they had, right? When we first entered this market, it was blow and go, just like the oil and gas market when oil's $120, right? $100 plus. Everybody's making money. Everybody's happy. Everything's going great. When things start to slow down, that's when everybody has to start being more strategic, right? We've talked to a ton of lenders that I tried talking to, call it 6 months ago, 8 months ago, and they were saying, I'm way too busy, just too busy right now. Well, those same lenders are now coming back and saying, wait, what was the data you said you had? How can we leverage that data, right? So in this transition, and we saw this again in oil and gas, there's really a transition going on from a relationship-driven industry into more of a data-driven industry, right? Because that's really where the future of this business is going to be. So yeah, today we see things starting to stabilize. The market's still highly disaggregated. I would have thought that there would have been some consolidation. Have not seen that. There's maybe some things going on behind the scenes as far as consolidation goes. But the number one thing that I think people are focused on today is their capital markets providers, right? Nobody now is going to be single sourced. A lot of those lenders that were single sourced earlier in the year are now doing a good job of trying to work with the banks, work with the insurance company, work with people that may have otherwise taken longer to approve a deal or buy a loan. They're now going and arming themselves with more people to talk to. So yeah, so just in recap, we're obviously the end of 2022 was a tough end of the year. That being said, we're starting to see things normalize. The top 10 is not growing as we would have expected. And we have seen a new entrance of a lot of non-QM folks that, traditionally wouldn't be considered private lenders that are now kind of, getting a little bit more aggressive because they realize the conventional side of the house is slowing down as well. So that's really what we're seeing. And, upcoming in April, I'm going to be joining Nema at the conference. And we'll be, talking about more in depth. And if there's any questions or anything, feel free to reach out. you can reach out to myself, or you can reach out to Kyle Welch or any member of our team.
Appreciate that, Sean. And got Sean's email address up in here as well. So if anyone wants to reach out, one thing that Sean didn't mention, but I think it's probably worthwhile particularly for Forecasa purposes is, Forecasa is in the business of aggregating data. Their users are often mortgage originators. And one of the things they have, if you think about recording data, is they know who all of the borrowers are, and they know when their loans pay off. And so that they have a data trove that really understands the industry in just incredible ways. We're really blown away by what they've been able to produce, and it's something that we've been kind of searching for many years over here at Jurassic.
Thanks, Nema.
And then one other point, Sean mentioned it as well, which is hopefully you found value in this. Like I said, our intent is to kind of have recurring state of the markets. The first one, because it was we are in a fast moving market, particularly from a rate environment and volume environment, wanted to report on that right away. And I know that's top of mind for many of our clients. And I wanted to make sure that we got that out there right away. But we'll have different presentations going forward and with the same theme, which is kind of what's happening in the marketplace as it exists today. Sean and I will be presenting at our upcoming Innovate conference, which will be up in April. This is kind of a glimpse, but really doing a deep dive, right? We can get down to geography and really parsing apart Q1. At that point, we'll have the entire Q1 data set in. And I think it'll be really exciting to take a deep dive into what does the first quarter of 2023 look like, and really getting an understanding of that. We'll also have Rick Sharga with us as well. Many of you know him previously with Adam. And Rick Sharga is going to be presenting with us. And Rick is a tracker of all foreclosure activity. And so, we'll be able to marry the three components together, right? So origination, terms, volumes, interest rates, and we'll be able to also understand is what markets are having the highest incidence of foreclosure. I know that's something that Sean also tracks as well, but we'll be able to really marry the full cycle of the loan from a data perspective at the event in April. So hopefully we'll see a lot of you there as well. And Sean, I know you had unmuted, so make sure you get an opportunity to say anything you wanted to say here as well.
Yeah, no, I just saw a couple of questions in the feed here. So unfortunately, it's an anonymous attendee, but we do remove self-directed IRAs, family trusts, and what I would call individual lenders. We don't necessarily remove them. We just tag them as a separate grouping. So if you wanted to know equity trust company, Cama Plan, whoever, the self-directed IRA, we tag them. But for purposes of comparing them to somebody like Kiavi, we thought it's not really a true apples to apples representation. And we will be bifurcating out long-term versus short-term loans going forward. So yeah, we don't remove them necessarily. We just bucket them in a separate instance. And we do that with even conventional lenders working with LLCs, right? There's a whole we look at all business purpose entities. We aggregate the data by state, by MSA, by county, or by county, by MSA, by state, and then you could do national. We do have a borrower profile for every private lending borrower. So what that includes is basically all the transaction level history for a borrower. So if you want to look at how many deeds have they had, how many mortgages have they had, we merge all the single purpose entities into one. So if someone's operating under multiple entities for each address, the property that they do. So yeah, we look at both. Once we have the lenders identified, then we can look at who's in that lender's network, whether it's the investors, borrowers, or the actual capital markets providers.
Thank you, Sean. And that was the last question that I see here in the queue. And we'll give it another second to see if there's anyone else who's got any questions before we finalize here. But and perfect timing. So
interest rates. No, unfortunately, interest rates are not part of the recorded document, which is why the relationship with Jurassic makes so much sense, right? So no, interest rates is the number one question we get. You do get loan amount, address of the property. You get the maturity date a lot of times. But the reason why Jurassic has lightning docs, right, is that there are no Freddie or Fannie templates. every single lender, if you're not using somebody like Geraci's, has their own documents, right? Which is kind of like the Wild West. So every lender chooses to report things differently. And each product that they offer typically carries a different document as well, because a construction ground up loan is going to have different reps and warranties and all that type of stuff as well.
That's right. All right. Well, thank you so much, Sean. And I'll go ahead and I know, Kat, you wanted to leave some closing remarks here as well, but thank you to all who attended this webinar here today. Hopefully you found some value in what we're doing here.
Thank you so much for joining us, Nema and Sean. We will have the recording up on the site in 2 weeks and be making email announcements when that's there. And in the meantime, if you do have any questions for Nema or Sean, feel free to reach out to them directly, or if you didn't catch their emails, you can reach out to AAPL and we'll pass it along. Our email is contact@aaplonline.com. Thank you all for joining us here today.
Thank you all. Take care.